Good morning, guys. Yeah, bit of mixed data coming out of, well, not so much out of the US. That's all pretty strong. You've got the US durable goods and manufacturing. That's all strong. The key one is the consumer confidence, right? You're in the election coming up later in the year. And Biden's running around saying that they'd vote for him because he's a good economic leader and that unlikely to have a recession was his call. I just saw. Come back here. The president says the economy's so strong now, no recession. Right out. Data is mixed on that front, right? So when you certainly you look at that information, that's fine, but what you're going to be seeing on the back of that is interest rates rising, and we can see the 2-year bonds rallied again overnight, and the 10-year also rallying. So the odds of a rate hike, another rate hike coming next month in July, is now 75%. So whilst the data coming out of the US is showing still signs of strength, that would also show that inflation is still an issue, and therefore interest rates need to continue to rise to try and combat that. But for the moment, stocks don't seem to care, and we see broad rally across the S&P 500. Over here in Australia, company profits put the surplus, budget surplus, and that's not because of Albanese's policies, far from it. In fact, his policies are probably opposite to that. But yeah, the issue is, and Tyler Durden sums it up, is that you've got strong data which is hawkish, which would mean that interest rates are going up, rate hike odds are up, which is the hawkish response. Stocks are up, which is a dovish signal, easing financial conditions. How does that work? Bond yields up, which is a hawkish response. Dollar down, which is a dovish response to a hawkish shift. I'll try and work that out. Commodities are down, which means or implies that there's demand fears from rising interest rates. And we go and have a look at the commodities. I was just on that page when we started. You've got oil off, you've got gold off, you've got iron ore going sideways, wheat getting smashed, coal weaker, natural gas turning down to the downside, copper, which is the bellwether for recessions or global growth, also off, as is the commodity index. So we can go and have a look at the Aussie dollar, not doing too well. Let's get out of that. Come here. Aussie dollar is not doing too well in comparison to all the majors. I'll just bring this in. We can see, dollar yen. We can see euro dollar and Aussie dollar just going nowhere. In fact, if we go to the US dollar as a group, probably more pronounced. You've got the pound having another run, euro having a run, Aussie dollar going nowhere. You've got the CAD getting weaker, and that's a commodity currency as well. And the yen, well, it's always weak because the BOJ do nothing, but the BOJ's line in the sand is 145, so we'll go and have a look at that. Anything else we want to have a look at? Bitcoin was sort of range bound between 30 and 31, 26 and 31, but on a daily, on an hourly, it's just going sideways. So all in all, you've got stocks getting bullish, again getting ahead of themselves, aren't they? If economic data is so good, then surely interest rates are going up, which means no free cash and makes it harder for companies to produce a profit, and therefore why should you own stocks, particularly when the dividend yield on across the S&P 500 is now lower than the yield on a bond, whether it be a 10-year bond or a 2-year bond. So why wouldn't you own the safer asset of bond and get a higher return? Doesn't make sense to me as to why stocks are getting all hot and bothered. But VIX is showing no sign of fear. So Yeah, go figure. Let's go through the majors. Aussie dollar, as I said, going nowhere. Kind of back in the middle of this range of 66 to 68. Just dull and not going anywhere. We've got CPI data today, which might will certainly indicate that the RBA are going to have to raise interest rates again. And no doubt the federal government will, in Australia, knowing the Labor parties as I do, they will take that surplus and spend it, which is only going to add more stimulus to them. Rather than save it and pay off debt, they'll spend it and what are they, as they call it here in Australia, pork barrelling, which is just spending in key areas where they think they might lose the vote. And that's going to add stimulus, which makes the RBA's job even harder. Euro dollar turned. Still don't know if I believe in this, because if the interest rates are going up in the US and stocks are therefore stocks should weaken, then the US dollar should be stronger, right? If we're looking at the US dollar, it turned a little. Nothing significant out of that just yet. If you get another day of selling, then perhaps, but at this stage I'd still prefer to be long US dollars than short. So I don't know if I believe in the euro. If you want to trade euro as itself, then go and look at the euro against a weak currency such as the Aussie or the yen. Right? So you don't want to trade two currencies that are equally strong. You want to trade a currency that's a strong currency against a weak. So you can see the euro Aussie doing very well, euro yen doing very well, because you're trading a strong currency versus a weak. And you'll see that across the pound as well. There you got that stronger pound against the yen, against the Aussie, against the euro there. CAD going sideways against the Kiwi, getting stronger too. So that's the idea with currency trading. You're trading a pair, so you're wanting to trade a diversion of economic situations. So when you've got two strong currencies, such as the US and the pound, then that makes it tricky to trade. So when you've got this one pound here, that looks great to trade from a technical perspective, but from a fundamental situation, I don't see too much upside to that when the stocks peak or interest rates go up again. That's going to get sold off because the US dollar will strengthen. Right, I hope the mic is better this time, but I'll see you guys next time. Trade accordingly.